Would you like to collect a market-smashing 5.3% yield? Want that big dividend to be safe and growing? Like the idea of being invested in a company that has some of the most impressive pricing power you'll ever see? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high-quality stock that pays big, growing, reliable dividend. These growing dividends are funded by growing profit because this business is selling addictive tobacco products to millions of consumers around the world. Now, tobacco usage is in secular decline. You can either cheer or jeer that. It's up to you. I'm not the arbiter of morality. I'm here to help investors make wise long-term investment choices and make some money. And this business looks very compelling right now, especially with their profit growth actually accelerating on the back of an exciting and new fast-selling product. That profit growth acceleration could lead to dividend growth acceleration, which is music to my ears. I've personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. Best of all, the stock looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Philip Morris International Inc., which appear to be trading at a significant discount today. Philip Morris International Inc., stock ticker PM, is the world's largest publicly traded tobacco company engaged in the manufacture and marketing of tobacco and related products. Originally founded in 1847, Philip Morris International is now a $141 billion by market cap global tobacco colossus. Fiscal year 2020 revenue can be broken down geographically as follows. European Union 37%, East Asia and Australia 19%, South and Southeast Asia 15%, Eastern Europe 12%, Middle East and Africa 11%, and Latin America and Canada 6%. The company's global market share is an estimated 28%, excluding China and the United States. That impressive market share is based mostly on the strength and ubiquity of their Marlboro brand, the #1 cigarette brand in the world. This one brand alone made up 37% of their total cigarette sales volume for last year. That brand loyalty is formidable, but it's especially formidable when you combine it with the addictive nature of the products. This combination of brand loyalty and addictive properties makes the product incredibly price inelastic. An increase in price doesn't significantly reduce demand. This level of pricing power is very rare. It's a unique tailwind that has blown the company's way for years and helped them to weather all storms. This tailwind sets the company up to continue growing its profit and dividends for many years to come, despite the secular decline in the use of its main line of products. Philip Morris has increased its dividend for 13 consecutive years. That track record is as long as it could possibly be, as it dates back to the company's initial spinoff from former parent company Altria Group Inc. in 2008. The 5-year dividend growth rate of 3.2% won't knock you dead, but it beats inflation. What might get closer to knocking you dead is the stock's 5.3% market-smashing yield. That's a very high yield in this low-rate environment. It's more than 3 times higher than the broader market's yield. The payout ratio at 93% is admittedly high. However, the company has an idiosyncratic accounting structure. Philip Morris's headquarters is in the US, but they don't sell products in the US. This sets them up for somewhat volatile GAAP earnings per share when they convert foreign profits into US dollars. Nonetheless, the company has always operated with a high payout ratio, and their free cash flow even more comfortably covers the dividend. This stock offers you a big dividend that's growing in the low single-digit range, which is well suited for older investors and/or investors seeking income. Looking at business growth, Philip Morris's revenue dropped slightly from $31.097 billion in fiscal year 2011 to $28.694 billion in fiscal year 2020. Revenue is down because of a secular decline in smoking, which has caused consistent drops in volume year after year. But this is actually better than it looks. Volumes have been declining at precipitous rates. For example, fiscal year 2020 showed an 11.1% year-over-year drop in cigarette volumes. Even with these massive drops in volumes, Philip Morris is able to keep things fairly steady. I think that's impressive. Furthermore, the company actually grew its bottom line over the last decade. Earnings per share increased from $4.85 to $5.16 over this 10-year period, which is a compound annual growth rate of 0.69%. Share buybacks aided bottom line growth. The outstanding share count is down by approximately 12% over this 10-year stretch. So the company is actually growing its profit and dividend despite a consistent drop in volumes. That casts a bright light on the pricing power I mentioned earlier. But what's exciting about a company just treading water? If the company can do this with a secular decline in its main products and a strong dollar that reduces its GAAP earnings per share potential, what could it do with volume growth and a weaker dollar? I bet they could do much more than we've seen, and I'm not alone with that viewpoint. Looking forward, CFRA is forecasting that Philip Morris will compound its earnings per share at an annual rate of 6% over the next 3 years. This leads me to the point I'm trying to make. Philip Morris already has incredible pricing power that can keep the business growing at a slow rate, even if volumes are contracting and the dollar is strong. But the recent weakening of the dollar is one advantage. The bigger story, however, is their IQOS product. This is the revolutionary heat-not-burn tobacco product. Whereas traditional cigarette volumes contracted by 11.1% last fiscal year, heated tobacco shipments increased by 27.6%. This strategy of embracing the future is helping the company to offset the secular decline in smoking with a product that is actually growing. The IQOS is new, but early results are promising. If we look at more recent bottom line growth, Philip Morris compounded its earnings per share at an annual rate of 3.6% over the last 5 years. There's an acceleration occurring here. This leads me to believe that CFRA isn't afoul with their earnings per share growth forecast. The worst case scenario in my mind is one where Philip Morris continues to only increase the dividend at a low single digit level, but that would be very acceptable dividend growth since the yield is so high. Meantime, there's the potential for a lot of upside surprise as it relates to future dividend growth. Moving over to the balance sheet, the company maintains a pretty solid financial position. The long-term debt to equity ratio is not applicable because of negative common equity, but their interest coverage ratio of over 16 indicates no issues whatsoever with their debt load or interest expenses. Profitability, as you might already expect, is extremely robust. After all, they specialize in a high-margin addictive product, and the cost to manufacture the product don't rapidly rise even though the strong pricing power is there. Most of their operating cash flow drops straight down. It's a cash cow. Over the last 5 years, the firm has averaged annual net margin of 24.81%. Return on equity, however, is not applicable again because of negative common equity. This is a slow growth, high yield stock that's great for income-seeking investors. And with growth accelerating, there's actually a lot to be excited about. Plus, the company benefits from competitive advantages that include pricing power, brand loyalty, global economies of scale, and high barriers to entry. Of course, there are risks to consider. Litigation, regulation, and competition are omnipresent risks in every industry. This business has long faced regulation and litigation risks that greatly exceed what the average business would be looking at. On the other hand, the entrenched players, while competitive with one another, are given a huge advantage by way of it being virtually impossible for a new cigarette company to start up today. This has created a global oligopoly. The US dollar is a risk because of the aforementioned accounting idiosyncrasy. A slowing of the adoption of IQOS would reduce the company's ability to offset traditional cigarette volume declines. Lastly, any increase in traditional cigarette volume declines would hurt revenue, profit, and the sustainability of the dividend. Overall, I view these risks as manageable, and the stock's low expectations have produced an attractive valuation that makes the investment that much more compelling. The stock's price-to-earnings ratio of 17.6 is well below where the broader market is at. While I think the stock's lower growth rate deserves a lower multiple, this is well off of even the stock's own 5-year average price-to-earnings ratio of 20.3. The price-to-sales ratio of 4.9 is slightly below its 5-year average of 5.0, and the yield is right in line with its own recent historical average. I valued shares using a dividend discount model analysis. I factored in an 8% discount rate to account for the high yield and a long-term dividend growth rate of 3%. This dividend growth rate is on the conservative side in my opinion. It is in line with the 5-year dividend growth rate, and the most recent dividend increase announced in September 2020 came in at about 2.6%, so I'm right in that range here. However, I really do believe that the business is on the cusp of a stronger tailwind gust than it's had in years, and that could lead to much higher dividend growth than shareholders have become accustomed to. On the flip side, I do like to err on the side of caution with these long-term forecasts and valuation models. I think this is a very reasonable estimation of the forward-looking growth profile, which should lead to a very reasonable estimate of intrinsic value. The dividend discount model analysis gives me a fair value of $98.88. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis that simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates Philip Morris as a 4-star stock with a fair value estimate of $108. CFRA rates Philip Morris as a 5-star strong buy with a 12-month target price of $100. I came out on the low end, but we're all in a pretty tight range. Averaging the three numbers out gives us a final valuation of $102.29, which would indicate the stock is possibly 13% undervalued. Here's the bottom line, guys. Philip Morris International Inc. is a high-margin business that benefits from extremely unique competitive advantages. After a period of languishment, growth is starting to accelerate. With a market-smashing 5.3% yield, more than a decade straight of dividend raises, inflation beating dividend growth, and the potential that shares are 13% undervalued, this stock could be a perfect fit for dividend growth investors seeking safe income for their portfolios. And now for a special news announcement. Microsoft just announced that it's entered into an agreement to acquire Nuance Communications in a deal valued at $19.7 billion. This gives Microsoft leading-edge AI technology to bolster their enterprise offerings. This is exactly the kind of move you want to see from Microsoft. They're not content to sit on their laurels, rake in the cash, and watch new competition pass them by. Instead, they're constantly expanding, adapting, and growing. I see Microsoft stock as undervalued, as I recently highlighted in a video, and this kind of move only reinforces my opinion. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so that you don't miss out on new content. Also take a look at the description box below for some important links, including a link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over at Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who have been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.